Imagine waking up, opening your phone, and seeing your retirement account down thousands of dollars, even though you didn't buy or sell a single stock. There is no breaking corporate scandal, no global financial crisis to explain the sudden drop. The stock market doesn't price in what is happening today. It operates entirely on what investors believe will happen next. When that future becomes unclear, the resulting uncertainty triggers massive sell-offs. Right now, institutional investors are paralyzed. They are obsessively watching three specific macroeconomic data points. A single headline about any of these three factors can instantly wipe out or generate trillions of dollars in market value, directly altering the trajectory of your personal savings. This diagram reveals a frustrating contradiction. Positive job growth can damage your portfolio. When employers hire rapidly and wages increase, consumers have more money to spend. That elevated spending forms a rigid floor under prices, making it incredibly difficult for inflation to drop. To combat stubborn inflation, the Federal Reserve must maintain high interest rates. This means every time we see a strong local jobs report, Wall Street sees a guarantee that expensive borrowing costs will stick around, threatening profit margins and market stability. Artificial intelligence development has become the primary engine keeping the broader stock market afloat. To maintain this momentum, large technology companies are pouring billions of dollars into physical capital, specifically data center hardware and advanced semiconductor chips. This visualization demonstrates the structural risk. Major market indices have become dangerously top-heavy. A handful of massive tech corporations account for a disproportionate percentage of the market's value, supporting thousands of smaller companies. If these tech giants fall short of AI expectations, their massive size ensures they will pull the entire market down with them, overriding positive performance elsewhere. Hovering above all of this is the Federal Reserve. Their interest rate policy dictates the value of nearly every financial asset on Earth. Investors must guess between two paths: keeping rates high against inflation or cutting rates to rescue growth. Markets do not wait for an official announcement. Traders frantically price in these scenarios immediately, sending stock prices surging or plummeting based entirely on whispers and rumors weeks before a decision is made. This mechanism illustrates how the three elements interlock. A strong jobs report locks in high rates, which makes borrowing from massive AI infrastructure wildly expensive, directly threatening tech earnings, and by extension, the entire market. These institutional shifts do not stay confined to trading floors. They directly dictate the balances of your 401k, individual retirement accounts, and pension funds. Watching your hard-earned retirement savings violently fluctuate during these periods of macro uncertainty is psychologically exhausting. This graph shows a very long-term market trajectory, revealing that severe, short-term downward spikes are an entirely normal mathematical reality of long-term wealth accumulation. Selling off your assets to stop the pain locks in those temporary losses. Making permanent emotional decisions based on standard market swings inflicts significantly more damage on a portfolio than the volatility itself. Your objective isn't to predict exactly what the market will do tomorrow or to find a way to eliminate volatility. The goal is to comprehend these drivers so you can observe the chaos without reacting. Maintaining a consistent, diversified investment strategy is the best defense against panic. A single hot labor report or a modest tech earnings miss is a data point, not a reason to liquidate your strategy. Understanding the mechanics behind the headlines replaces financial panic with strategic patience. So, looking at the data we have right now, do you think the stock market will hit new highs this year, or is a correction coming? Let us know in the comments.